So we're looking at historical context. This is, of everything here, this is my favorite chart. And you're going to be like, what the? I'm a dork, so just bear with me. So a lot here, but there's a very simple message. This is the price action of the S&P. No dividends built in, it's the price of the S&P 500. This is a regression, and this is not exactly what a regression is, but this is how I'm reading this, and see if this makes sense. This is my overlay on this chart. So what is it that makes that smooth line possible? And what is this up here when the blue line's above the red line? What does that mean? When the blue line's below the red line, what does that mean? Right? If the red line is sort of if you can make that a projection, if you could right here have said, you know, I think that red line will continue that's been this far. What does that mean? What do you think that red line could be quantified as? Remember we talked about earnings, and earnings can be cuts or it could be revenue growth. I think, and just see if this bears out in your own minds, I think that is the long run 6 or 7% average annual revenue growth of the corporations in the S&P 500. And I think that everything that happens above here is our own, you know, crazy valuation. And everything that happens down here is our own crazy undervaluation. Right? So when things get really, really nuts down here, in 1982 it was really bad, 32 really bad, 2008 really not that bad. But what does that tell us? Right? That means if we are to have good returns, it's best to buy down here. It's best to buy under the line. Does that make sense? The definition of buying low is buying under the line. Does that make sense? We're above the line, right? So what do we do? What does that tell us? To me, that says it's a reminder we are in a secular bear market. Does everyone remember what a secular bear and a secular bull is? Okay. So some of you that are shaking your heads, I've had this conversation many times. Okay. So a secular bear is, so there's a business cycle that's a cyclical bull or bear market. It's a 3 to 5 year cycle. You get an upside and a downside. Secular is a debt cycle. It's 18 to 24 years. The last one we had was 1982 to 2000. The one before that was 1966 to 1982. From 1966 to 1982, the average return of the S&P was a negative 1%. From 1982 to 2000, the average return of the S&P was 17%. So we're unwinding huge debt, and then we're putting on debt. That's this growth cycle. That is 66 to 82. We're unwinding debt. 82 to 2000, we're putting on debt. 2000 to, we're taking off debt, right? So this to me tells, this chart, a variety of things that go into it, tells me we have more of this. We have 6, maybe 7 more years of volatility. Doesn't mean there's not going to be opportunity. Doesn't mean that we shouldn't be invested. It just means there's going to be volatility and we should expect that. In the portfolios that we manage, our highest growth portfolio is 50% equities, which is not the case when we're all excited about things. It would be 80% equities. Our benchmark is an 80-20, 80% equities, 20% fixed income benchmark. That portfolio is 50% equities right now, just to give you kind of a sense. Okay. This is why. So again, I love charts. So the green area is here, here, here. That is everywhere the Fed was active. This is, so I'm going to go back a chart. This bottom right here, 2008, 2009, is this bottom right here. Right? Everyone follow? Okay. So before this bottom hits, quantitative easing 1 happens. We get TARP, we get TALF, we get zero interest rate policy starting here. We do $1 trillion quantitative easing, which means we print $1 trillion and pump it into the economy. What does the market do? Yay! That ends. What's the market do? 20% decline. Oh, this is not good. We need to have more quantitative easing. We put in more quantitative easing. $700 billion this time. What's the market do? Yay! That ends. What's the market do? 20% decline. Okay, right now we're in the middle of it, and what happened was they had a meeting and decided, ooh, that Operation Twist, we can't let that end, we have to keep doing that. And they found a way to change the language so they keep doing it. So the only reason the market is up that much in that period of time is because we pump money into the system. What does that mean to pump money in the system? There's government contracts, there's printing money, giving it to the banks, we're paying interest to banks to hold money at the Fed. There's all kinds of ways we're pumping money into the system. Banks can then lend that money with guarantees. There's just tons of ways we're doing it. The point is, it all comes from the Fed. The Fed is controlling the business cycle. And if you really think about what's going on in the world, last Thursday, remember, so I went family camp. Wednesday I go to family camp. We have this conversation before I leave. I'm a little nervous. It looks like Spain's going to fall out of bed while I'm gone. Call the camp if that's a problem. There's no access to the camp. I don't have Wi-Fi. My cell phone doesn't work. Call the camp. Here's the number. If there's an issue, call me. What happens on Thursday morning? Draghi gets on the air and says, the euro, we will do whatever it takes to save the euro. Does everyone remember this? It's over the weekend. It's in every newspaper. Can he do anything? No. He can't commit Germany's capital. He can't. But he's going to say it because it supports lending, and it brought lending rates for Italy and Spain down below the threshold where it matters. It's a complete illusion, right? It did not solve a thing. U.S. markets responded with a 4% uptick. It's federal and it's central banker managing the economy, and it doesn't work. And eventually, this Operation Twist will stop. The QE3 conversation will throw our hands up. It didn't work because it's not doing what we need it to do. This is what it's doing. So we have corporate profits as a percentage of GDP, 10.1%. Long-term average is 6.2%. 50-year average, 6.2%. It's at an all-time high. It's huge, right? So they're laying people off. They're buying equipment and things, which is fine for expenses. It keeps expenses down, keeps profits up. As investors, we like that. As shoppers, we like that. You know, it's nicer to buy a Ford today than it was 2 years ago. It's higher quality. It's got better safety standards. It's beautiful, and it's less expensive. Remember, the revenues are high. The revenues are they're doing really well. But how much of that is because of the liquidity the Fed pumps in? How much of those earnings can be traced directly to stimulation offered by central banks? There's no way to really answer that question, but some percentage. It's interesting, we have more stimulus than we've ever had, and at the same time we have the highest corporate earnings we've ever had. That's just, it's not causal maybe, but there's something going on. So consumer debt. So we talked about this, I don't remember, there was a comment earlier. Do you see a time since 1950 where consumer debt has been paid off there? No, hasn't happened. And now it's happening. And it's happening, some of it's write-offs, some of it's people paying down debt. Has anyone refinanced their mortgage and paid money in to qualify for a lower rate? I did too. I did. So I have people, in the last 2 weeks, I had 3 or 4 people say, should I do this? I'm like, I just did it, right? Maybe that's what you should do, right? So it's definitely a good idea. So we're paying off debt, we're also refinancing, getting lower rates, and we're saving more. These are all interesting things when you think long term. Right now they're painful. It shows a slow growth. It shows a consumer that's not confident. It shows companies that are not confident. But the more we save, the more we pay down debt, the closer we get to that place where we are more confident, because now we have this whole pool of cash. Individually, our expenses are lower. Companies' expenses are lower. So it's a very good thing long term. But here's the deal. Consumer debt as a percent of GDP, the times when the stock market does incredibly well are when we're adding on debt. That's that 82 to 2000 range. That's when stock market does well. Why is that? Because we're borrowing to buy. That's it. And now we're not borrowing to buy. Stock market's struggling. That's called deleveraging. There's books and books and books and books written about this. There's articles written about this every day. We are in the midst of deleveraging. We're not done. We have 6 or 7 more years of this to go. Employment as a percentage of total population. See right here we have, 58.5% of the population. One side of the aisle will say, well, that's because unemployment is high and Obama didn't do a very good job. The other side of the aisle will say, well, some people are retiring. Remember, baby boomers retiring? Both are probably true. They're both making a political point. This may not be that bad a deal. There's a lot of people that don't want to work anymore. It's not just people who have lost their jobs. Wages as a percent of GDP. So we all know this is happening. This is what you mentioned earlier, the 99 and the 1. That's what this is. It's been going on since 1960. It's not a new phenomenon. Okay. A couple more interesting things on birth statistics. So the greatest boom of all time, 82 to 2000, it's about 35 years after the baby boom. So what happens when we're 35, 40 years old? This is the interactive part. What happens when we're 35, 40 years old? Right, we're sort of reaching our earnings years. We're reaching sort of peak earnings, and we're starting to spend money. We're buying houses, we're buying cars, we're buying goods. So when you have a baby boom, 35, 40 years later, you have more productive citizens earning more money, spending that money in the economy. So Annie, my daughter, was born in 2007, so I get to be part of this particular baby boom. It's roughly the same size in terms of that 1 year as 1957, which was the peak of the last baby boom. I've seen a ton of babies. I think we're still in a baby boom. I don't have the data to back it up because I don't have census, but yeah, I think we still there's a lot of babies out there. So this is why that's important. So when you have a working age population that is producing and creating their income stream, they're spending that income stream in the economy, economies grow. This is the United States. We're going to add 50 million working age population between now and the year 2050. China is going to lose 200 million because of one child, right? Japan has been in this issue for a long time. Japan, A, low birth rates, B, they export their workers. They come here. They go to Europe, right? So they don't have a generation that's coming up behind running companies and working hard. So in the year 2050, or between now and 2050, we actually have a huge advantage. I want to put this up there because this is positive 2% days, negative 2% days, year over year. So what happens when deleveraging occurs? It's tied with a secular bear market. A secular bear market is tied with volatility because there is no direction that we can understand. When there is no direction we understand, then every headline moves us to action because we are terrified and we're excited, and we're terrified and the problem's solved, and then we're terrified and it's not solved, right? So that's what we see here is that, remember the debacle starts in October of 2007. That 6 and 11 happens in the last 2 months of 2007. So from this point forward, that's when the volatility started. In 2004 and 2005, there were no 2% up or down days. None. 2006, there were a couple positives. 7, at the end of the year, lots. 8, it was insane. Last year, more negatives than positives. This is not saying that it's a bad time to invest. It's a good time to invest. That's not what this is saying. It's saying expect volatility. We have 6 or 7 more years of this.